Hey everyone, I'm going to show you now how to properly analyze the cash flow of a particular property and help calculate the tax liabilities, and with the goal of analyzing the total after tax cash flow. Okay, let's start with some. So this is an example of a property that I'm actually have an offer on that I'm considering buying. So just add some general information. Start my name. I won't disclose the information of the property now because I'm trying to buy it right now. It's a condo. So here we go. So we first set, I have a $153,000 purchase price that's been agreed on, like I said. And the first thing we do is start looking at the income of the property. So this particular property has a potential income of $2,000. It's currently rented at $15,000, but there's a potential for $2,000 a month because I plan to rent it per room. So I always put the potential income, not the actual current income. From there, you'll see I have preset some formulas. So first thing we start with is a vacancy or bad debt. So this is what we usually do is take 4% of the gross potential income. This is kind of a market average. This is used for potential vacancies or any loss of rents from bad tenants. From there, from that you get your effective income. After the effective income is calculated, we do add some additional income, which is usually like extra parking or laundry or whatever. But this particular property doesn't have that, so there's nothing for this, and that gives us our gross operating income. So from there, we start looking at the expense of the properties. Now, I own a very similar property, so I know the expenses. They're not estimated; they're actual expenses. So I'll just go through them quickly here. It's $194 for property tax. Condo is $299. Condo fees. The insurance is actually $22 a month because the majority of the building insurance is covered by the condo fees, as most condos do. Repairs and maintenance. So for this, I've set it at 6%. As you can see, the formula up here. 6% of the potential income I set at repairs and maintenance. That will kind of alter depending on the property in the area, but so for this I did set it at 6%. Hydro, I have it at $320 as for my previous property that I own, and internet I pay for this type of property, and that's $51 a month. So you'll see that gives us our net operating income, $914. From there, we will need to calculate our mortgage financing, and I'll show you why later. So this is a property I'm trying to purchase with zero down, so essentially financing the entire 100% of the purchase price. So my bank has quoted me the following here for the first mortgage. So this is a 75% loan to value, which you can see again. The equation up front is B5, which is the purchase price times 75. That is $114,750, and here's all the terms. The 5-year, 5.2 monthly payments, 25-year AM, and it's blended constant payments, which is the same payment over the term and includes principal and interest. And the second mortgage you'll see up top is B5 times 25%, which is the remaining 25% of the purchase price. And for this, it's an interest only, it's not amortized, and that's at 9%, so the payments will be interest only. So your first mortgage payment, I'm not going to get into the calculation, but it was $681 per month, and then the second mortgage payment is $287 per month, again, interest only. So from there, we need to calculate the overall tax liability on the property, and that is done by this equation here. It's your net operating income minus your mortgage interest. Again, it's not your mortgage payments, it is your mortgage interest, because you can't deduct the principal portion of a mortgage payment in Canada. You can in the United States, but not in Canada. We also subtract any amortized loans, and then we subtract our capital cost allowance, which is our CCA, and I will get into that in a second. You might multiply all that by your marginal tax rate, and that is the rate essentially that you'll be paying at tax time, and that'll depend on the individual, and again depends on other individual sources of income, etc. And that'll give us our overall tax liability, and from there we're able to calculate our total after-tax cash flow. So we'll go through the numbers here. Again, net operating income we start with is $914. Again, you see it at the top. It's just equal to B21, which is brought over from here. Our first mortgage interest. So you'll recall that our first mortgage payment over here was $681, but that's again blended, as you can see here. That includes principal and interest. I won't get into the calculation, but I had pre-calculated that it's approximately $466 on the average per month, which is your interest portion. So we put that over here. Your second mortgage interest, you'll see it exactly equals B27, which is here, because again, this is an interest-only loan, so the entire payment is forms part of the tax deduction. There are no amortized loans, so we do not include anything here. And then we subtract our CCA. So without getting into the tax law in depth, what CCA allows is the Income Tax Act allows us to depreciate the building portion of a property because CRA deems that building and fixtures of those natures depreciate over time. They lose value over time. So for buildings, they allow 4% to be deducted on an annual basis of the building portion only. Now over here you'll see I have the equation B5, which is the purchase price, times the 0.4% divided by 12 is your monthly portion. The reason I'm using $153,000, which is the full purchase price, is because in a condo, the entire portion of the property is building. There is no land essentially. So if this was a normal house, there would be a ratio of land to building that I would use here, but again, because it's a condo, we use the full amount. So that's 510 is the equation. That gives us our income before tax, which is, again, it's negative $349. So I have estimated that I usually pay around the 30% tax bracket, but when there's a negative cash flow, there is no tax at all. So there's a zero tax liability on this particular property. And then we finalize that with our after-tax cash flow, which is this equation here. It's your net operating income, which again we've used and we calculate over here, minus your total annual debt service, and then minus your tax liability. So we'll bring up the equation here. As you can see, it is E9, which is again your net operating income. We go back, and that includes, then we subtract our annual debt service, which is our B26 and B27. You'll note that it's the full mortgage payments, not just the interest payments here, because this is actually part of our cash flow. It comes out of our pocket every month. This we use here to calculate the tax liability, but we use the full mortgage payments to calculate the after-tax cash flow. So we subtract that from net operating income, and we subtract E16, which is our tax liability, which there are none, and that gives us a minus $54 a month after-tax cash flow. So out of the gate, you can see it is hovering around the zero mark. Now I haven't decided to purchase this property or not. Just because there is negative cash flow doesn't mean that I will not purchase it, and there's a couple reasons for that. First, I believe the property is worth approximately $165,000. So at a purchase price of $153,000, there is an instant net equity stake of $12,000, which is an increase in net worth of $12,000, and that is easily offset by this minus $54 per month. So that's a consideration. Also, there's also some principal pay down to consider. So you can see our total mortgage payment is $681, but the interest portion is $466, and that's going to decrease over time. It's about $215 a month being paid towards principal, which is your equity buildup, and then again that offsets the $54. So again, I haven't decided. This is a general basic kind of formula that we use to analyze a particular property. Doesn't include things like market influences, long-term projections, or internal rates of return. It doesn't include risk probability. But again, it's just a general formula that everyone should use for analyzing a rental property. That's it for now, guys. Thanks for listening.